everyone. My name is Jessi Goostree, and I am the COO of the Texas Blockchain Council. And first, I just want to start by saying welcome to Texas, and even more than that, welcome to Dallas. Dallas is the home and headquarters of the TBC, and actually my home. So I hope you are experiencing some Southern hospitality, and if you're not, come see me, and I'll make sure that you are. It is my honor to be moderating the Navigating the Institutional Frontier panel, and in the next 25 minutes, we will explore the evolving digital asset landscape and what it means for the future institutional involvement. We are very fortunate to have some experts on our panel today, and first is Ryan Lessard. Ryan is the Director of Digital Assets at Fidelity Investments. We have Khurram Dara, Regulatory Policy Principal at Bain Capital Crypto, and a true pioneer in this space. Gave the first ever TED Talk on Bitcoin 11 years ago. Founder and Chief Executive Officer at Abra, Bill Barhydt. Gentlemen, I will ask you to maybe give a little bit of background briefly and maybe a highlight that you'd like to bring to the conversation today. Ryan, go ahead, I'll start with you.
Great, thank you. And thank you everyone for having me. Ryan Lessard, Digital Asset Strategist with Fidelity Investments, and more specifically, Fidelity Digital Asset Management. Believe it or not, one of two commercial businesses at Fidelity focused on crypto or digital assets as an asset class. And my day-to-day role and our team's mandate is one, bringing investment product to investors to facilitate access to Bitcoin and more broadly, this emerging asset class. And then the future state of tokenization of real-world assets and enabling technology to facilitate those traditional products, funds to come on-chain in some form or fashion as we figure that out as an industry. But my day-to-day is interacting with all types of investors and institutions, bringing both the best of Fidelity and then bringing education on this space, and been on this team for 4 years, so it's been an exciting ride and journey and watching that develop.
Hi everyone, Khurram Dara. I'm at Bain Capital Crypto, where I lead regulatory and policy. One quick disclaimer, these are my own views and not necessarily those of Bain Capital. Second disclaimer, I was in the green room during the last panel, so I didn't catch much of what Speaker Ryan and Faryar, who's my old boss at Coinbase, said. So whatever they said, if I say anything different to them, defer to them, they're correct. Prior to joining Bain Capital Crypto, which is a crypto venture fund investing across all stages, I was on the policy team at Coinbase. I actually got my start in the space as a practicing lawyer, working with projects that were launching protocols and tokens. And I'm excited to be here and hopefully offer a little bit of insight on the regulatory environment and outlook going forward.
Yeah, good morning. Bill Barhydt, I'm the founder and CEO of Abra. I think I can't really see all of you, but I know I have many clients in the room on our prime brokerage, which works for miners, VCs, hedge funds, a bunch of institutions providing auto liquidation for Bitcoin all the way through to post-trade settlement, credit, lending services, and then we have an asset management business that's the only registered investment advisor in the US doing yield, DeFi, lending, separately managed accounts, and the like. So super happy to be here. Thanks.
Thank you, gentlemen. Before we get into some of the more nuanced questions related to asset management or on the institutional side, I want to acknowledge that we have a pretty diverse audience here. So I thought maybe we would start with a question or two that might help connect the worlds of energy, Bitcoin, asset management, and maybe provide a little bit of a solid foundation for the folks in the room. So Bill, if you don't mind, I'm going to go to you. Why is it important or relevant for Bitcoin miners to be paying attention to the interest of institutional investors in digital assets? And maybe what are some of the other intersections both sides should be considering?
Oh, wow. So a few things. I think a couple of things. One, everybody's watching the MicroStrategy playbook. The number of companies that are coming to us right now to repeat that playbook is astounding. And we've set up a treasury arm just to deal with that. I mean, the demand, a lot of it is investigation, but given the vibe, I'm quite certain that we're going to see lots and lots of companies doing that, which I think has a significant effect, for example, on the mining space. But I actually don't think it's going to be just Bitcoin at scale. I think it's going to be baskets of crypto assets and then later securitized or tokenized securities as well. But it's going to be mostly Bitcoin to start, and then it's going to morph into other things. And the second thing that we're seeing on the institutional side is just huge demand for lending against borrowing against Bitcoin positions. So as more and more miners, family offices, other institutions are hoarding Bitcoin, now we're seeing this with Solana, we've seen it with Ethereum, the demand for borrowing against that crypto position is booming. I mean, really booming. It's demand that we can barely keep up with. And so that's something that I think people really need to understand, because there's significant tax implications, around capital gains, around expanding operations, and some very creative institutional financing things are going on in that lending area as well right now.
And we actually have a panel this afternoon that Chris Amarello from Coinbase is moderating, Bitcoin mining and treasury management at 1:30, if that is of interest to folks in the room. Okay, so shifting a little bit now, landscape of institutional involvement in digital assets. Ryan, Fidelity has been a major force in bringing digital assets to institutions. I would love for you to take us on a little bit of a journey. A quick look back at where we were, kind of what happened after the ETF approval, and then where you think we're headed.
Yeah, and believe it or not, many of you may not be aware, Fidelity, being almost an 80-year asset management company, started our journey with Bitcoin specifically and crypto at large 10 years ago now in 2014. So this has been a long time in the making to get to the point we're at today, where you're seeing kind of traditional institutions being involved in a meaningful way. And our firm took this earlier approach of making sure we understood an emerging asset or technology as we thought of it at that time. And we do this with many other things, not specific with crypto. And that approach we took, which I thought was really thoughtful of anyone that's trying to explore something net new and understand how it works, is to get your hands dirty, right? Actually physically be involved in that ecosystem. And in the case of Bitcoin, as many of you are more well aware than me, that means mining Bitcoin, right? So we started doing that at our firm in 2015, still do that 9 years later to this day in a proprietary fashion. And the learnings that came along with that helped us enable to think about how are we going to bring this asset or this technology to our clients. And what that looked like over the last more so 5 or 6 years was the two commercial businesses coming to the market. And we have first and foremost our digital asset custody business, which has been around since 2019, custodying a few different assets, including Bitcoin, for all types of institutional investors. And we use that word institutions, and we can unpack that today, as that's a really broad term, but means a lot of different things, and there's a lot of different considerations there. And what emerged out of that too was, integrating that custody service more recently into our traditional channels at Fidelity. So we work with all types of clients, individuals, family offices, financial advisors, record-kept workplace, 401k plans, and making sure we can enable access to this asset class in a way that works for them. So what came second, and had the pleasure of actually working with Jessi at this point, was in our digital asset management business. So we became, as an asset manager, interested in how do we facilitate, again, an emerging asset or asset class. And so that's changed, and how that's been received over the years, as you could imagine, and people's willingness to explore that, especially coming from the traditional side. But this year, with the emergence of different product vehicles, is we've hit that point of critical velocity, in my opinion, where it went from being this fringe asset, despite involvement from firms like Fidelity, that now, hey, I have a way to access this in a way that works for me. In that chicken and the egg problem of, do I spend time researching something that I can't actually access anyways for operational challenges, is a friction that's been removed, right? So we've now hit that point where no matter what type of investor we're talking to, there's reception and an understanding that you can touch these things, right, in a way that's operationally feasible. And for that reason, they want to learn. And that conversation has changed since the 4 years ago when I started. It was a lot of rejection of the idea, coming up with reasons to stonewall the conversation more than be intellectually curious. And now that intellectual curiosity is what gets me, encouraged and fired up every day, is people do care to learn and want to learn, right? And it will still be a process, as much as we might think it's somewhat of an overnight idea that we can understand intuitively. It's not for a lot of people, depending on their base case of where they come from. And so I think it's contingent on not just Fidelity at this point, but our peers, whether they're emerging crypto companies that have deep expertise, or traditional finance companies that have deep relationships with these investors already to bring education first, and the facilitation of the access will follow.
And I think outside of client education, the other major friction point is regulatory. So Khurram, from your perspective and your role at Bain, what are some of the biggest regulatory challenges institutions face today, and how is the evolving policy and the onboarding of the new administration going to change that?
Yeah, I think, more generally, the last few years have felt a little bit like The Empire Strikes Back. And I think a lot of us hope that we're now at the beginning of The Return of the Jedi. I think the challenge, well, I guess first what that actually looks like. I mean, nobody can predict the future, but personnel will be key. Leadership and staffing choices will be very important. I think at the very least we can expect a shift in enforcement priorities. I think the priority will shift towards fraud, market manipulation, bad actors, and perhaps less so on actors that are presumably acting in good faith but have a disagreement about the law or its application, and some of those cases that are a bit more novel, that are seeking to impact and change market behavior. I think you'll see some of that go away. A heavier lift would be on the regulatory side if we see agencies that are more accommodating through rulemaking, through guidance, perhaps exemptive relief, and then of course legislation would be much more lasting, though I think that is still probably a little bit further down the road. But stablecoins and market structure are areas that a lot of folks have been saying are on the map, on the Hill, especially given what happened last year with the progress that was made at the committee level. From an institutional perspective, I think one of the interesting things about the environment that we were in the last few years is that when you have an environment where there's perhaps a lack of clarity on certain key areas, it actually, I think, hamstrings two sets of actors in particular, very small upstarts or perhaps founders who haven't even entered the market yet, who feel like there's this very big burden they have to overcome, and also larger institutions who have perhaps multiple lines of business, and those other lines of business may or may not be regulated. They have more to lose in a certain sense. And I think in a lot of ways, when you look at banking, custody, these are areas where a lot of the traditional financial institutions have had a challenge entering because of this regulatory overhang. So that's one area, I think, looking ahead, where we can expect to see more adoption in the space. Just even a change in enforcement priorities and a little bit of clarity on the margins would help tremendously. And the other point that I would make as well is that, despite what you may hear, it is not the case that the regulatory environment for crypto assets in the US is the total Wild West and there's no regulation. First of all, nobody even wants that, but that's not the case today. Since the crackdown on ICOs in 2017, 2018, almost all the fundraising is done in an SEC compliant way or an SEC exempt way. The CFTC has authority from an enforcement perspective over the spot market to bring actions for fraud and market manipulation. All of the centralized exchanges in the US, Coinbase, Kraken, they're complying with the Bank Secrecy Act because they have money transmission licenses in every state that you can have them in and have registered with FinCEN. Many players are complying with OFAC sanctions, the ones that are in the US and have a nexus to the US. And so I think that there's this perception that crypto is this Wild West in the US and we need all kinds of new regulation here and there. Actually, what a lot of folks would like, and that would make a huge difference just for institutions being able to play, is a little bit of clarity on the margins here, as far as the boundaries between securities and commodities, and perhaps a rollback of some of the guidance that has restricted, particularly on the banking side, the ability for financial institutions to play in the space.
Bill, you've had to navigate this for quite some time. What advice would you give to companies maybe just starting out? How should they go about this?
Yeah, I would say, to build on Khurram's point, I mean, things have changed dramatically now. What were headwinds, I think, are going to become tailwinds, and so that's good. I think a lot of entrepreneur friends of mine in the crypto space that literally moved to set up shop in Zug in Switzerland or Singapore or Dubai may now actually reconsider the US. But regardless, my first advice is lawyer up. which is, having worked in tech for 30 years, pre-commercial internet, Netscape, worked on SSL. Yeah, there was a little bit of legal stuff going on with export control for cryptography, but by and large, we never thought about that.
Right.
You just basically solved problems for enterprises or consumers, and you were taking risks, and it wasn't that big of a deal. But this is a different, environment still, and I do think there are going to be new tailwinds that help us. More of an emphasis on regulatory sandboxes. Banks will be able to play. I think choke point will die a horrible death, as it should. And I think, just the idea that you can't get a bank account if you're operating in the digital asset space is absurd. Absolutely. That will change quickly. And so VCs will come back into the space, I think probably late next year. There is angel money in the VC space still for digital assets, but late stage funding is still pretty tough. So the companies that raised a lot of money in the last go around are either making do, or a lot of them are going to still fail. I think we may see some failures, unfortunately, but I do think that venture is coming back, and I think a lot of it is going to be comfort around this new kind of like lack of regulation by enforcement. And that has been kind of a disaster. You look at what Andreessen Horowitz did during the last election cycle, VCs coming out and talking about these things in a way that in my entire 25 years in Silicon Valley, I've never seen before. Generally, this is an apolitical environment in Silicon Valley, but now you have VCs coming out and saying, hey, this is ridiculous. You're hurting America's chances to lead in this space, and really taking a stand. And it had a huge impact. I mean, I think many people here realize this, but not to make this all political, by far, the biggest sources of, super PAC money in the last election came from our space. We were the proverbial cat pushed into the corner that basically said enough and just, scratched the eyeballs out of those who were standing in our way, and justly so. We weren't really doing anything wrong to justify, okay, so I was a CEO, entrepreneur, 20 years ago, post Netscape. If you had said to me, do you ever heard of a company getting a Wells notice? My first question would be, what's a Wells notice? And I know 5 CEOs at least who've gotten Wells notices who I worked with in the early .com days, and I can guarantee you they are not all fraudsters just waiting in the wings for 20 years for the crypto space to come along and say, oh great, now I can go commit fraud on the American consumer. It's absurd, right? And so the good news is I think that's in the past. And as you said, fraud should be policed, but save that, entrepreneurs should be allowed to be entrepreneurs, and I think that's what's going to happen now.
Absolutely. When you think about looking to the future, and now that that's in the past, what trends do you see on the horizon that could make digital assets more integral part of mainstream finance? How do we put these things together?
Yeah, so for me, DeFi is number one.
Okay.
I think what we call DeFi now is just going to be banking in 10 years. The same way, I used to have these conversations 10 years ago in my telecom days when, carriers were like, oh, VoIP's never going to happen, quality is terrible, and who uses a landline now that's based upon PSTN? No one, right? So that is the future of banking. The only question is, will the US come first, last, or somewhere in between? That's trend number one, and I think probably where a lot of people disagree with me, I do think we're going to see a strong movement towards using public blockchains for trading securities. And it just makes sense, right? You have 24/7 always-on networks. You can maintain self-custody. This is orthogonal to the way the US has thought about securities trading for 50 years, 75 years. But I believe it's coming, and same point. Either we're going to lead on this, or other countries will leapfrog us, and then we'll catch up. But I do think that this is also a trend that's going to kind of get newfound momentum in the next couple of years. Absolutely.
Yep. And Ryan, what would you say are the biggest opportunities institutions could be missing out on if they're not engaging with digital assets?
There's a lot. It's hard to start, and it depends on where they are, right? We said the word institutions, and I think it's important that that adoption of institutions isn't linear because there's different types of firms with many different considerations there. At Fidelity, we even bucket them up, broadly as institutional, but a financial advisor at a broker-dealer looks a lot different than a pension fund, right? In how they access or their ability to access this may or may not even be in their control today. And who they have to ask permission for varies quite broadly, and the timelines to get that permission vary as well. And so I think what you're going to see first and foremost is probably price exposure, just meaning folks allocating to this asset before they appreciate the technology that is the underlying network itself and the rails that it runs on. And so much of it will be, I view it as a funnel, right? Exchange traded products launched. We already had centralized exchanges. These are just ways to get new people into this world that we call crypto or digital assets. Their first exposure to it is often having price exposure in their brokerage account for the first time, right? And now they're like, oh, I own this Bitcoin thing. What is it? It's going up, it's going down, and I pay more attention. Maybe I invested probably without full due diligence, even though we would always encourage that. And they're going to learn more, going to be intellectually curious and appreciate the technology itself, right? And once they can appreciate, we own price exposure to Ethereum, and what can I do on the Ethereum blockchain? To maybe Bill's point, they start to realize some of the technological advancements that they can make without going too far and that already exist and they just weren't fully aware of. So I do think it may be a price exposure story first, at least from the traditional finance lens. And then in the background, maybe more so, you'll see institutions building on these networks, almost behind the walls or the curtains to the average investor in terms of not even realize they're interacting with some of these protocols at the end of the day.
And Khurram, as there continues to be more regulatory clarity, how do you think institutions should navigate this to operate more confidently?
Well, I want to answer that, but just before I want to pick up on Bill's point about securities trading, because I think it's a really astute one. So much of the intermediation in the securities markets was in part a product of not having the technological ability to do the things that we can do today. And just one example that I love is, everybody knows that usually when you buy stocks through your broker, the holder of record of the stock is actually your broker, and then you're the beneficial owner. One of the reasons that happened was, I believe in the late 60s, back offices couldn't keep up literally with the paperwork to settle trades, and so brokers started telling their clients, hey, listen, we'll just put the securities in our name, and we'll have a separate ledger internally that'll show your ownership. So just trust us to do it. And then there were all kinds of problems there when brokers, didn't, the funds didn't match up or didn't add up, or brokers went under, and you had a kind of a series of regulatory changes that solidified a lot of the intermediated framework because there wasn't this ability to have instantaneous settlement, to be able to have a less counterparty risk when you trade. And so I think it's a really good point. I think looking forward, I think institutions are very well equipped from prior experience on how to navigate the regulatory environment, how to engage with regulators. I think that the difficulty has just been this kind of lack of clarity and the regulation by enforcement. And so I think even a very low lift on the part of regulators that doesn't really even involve too much action, just a change in enforcement priorities, is going to fundamentally reset the landscape for institutions to be able to play in the space. And stable coins and custody, I think, are two really big areas where you see traditional financial institutions having a really difficult time engaging in, that I think are going to be looking forward potential areas where they're going to be playing in.
With just about a minute left, I'll open it up to you. Anything you'd like to close us with?
Yeah, I mean, look, I think this is a great time. I think the energy, the excitement that I'm feeling, a lot of it is due to the ETFs, and I think that's been great marketing for the space. But now I think, and no offense to the ETF providers, I think kudos to them for basically plowing ahead and seeing that through in a tough environment. It was an Empire Strikes Back environment, and I think now the real innovation phase is about to start. I think that we're coming out of a massive trough of disillusionment that was driven by a lot of fraud in lending and things like that. And some of the real innovative stuff that I'm seeing in smart contracts, real DeFi, not just like institutions being able to store ones and zeros on a hard disk, but real DeFi-based innovation is happening now at just massive scale, like all over the world. The number of developers, which has always been my yardstick for this, that's working on this stuff now is ballooning. And the last point that I would say, the trend that I'm really excited about, is the intersection of AI and crypto. I think AI is the second coming for smart contracts. AI agents that are self-propagating on the internet are going to take over everything, banking and everything. And those agents that make agent-to-agent payments can't be self-propagating if they need a bank account or if they need a stored value PayPal account. No offense to anybody that provides stored value accounts. So the only way to do that is true DeFi. And so I think that the merger of smart contracts and these AI-based agentic systems is going to be a multi-trillion-dollar business, faster than any multi-trillion-dollar business has ever developed in the history of mankind.
Excellent. Gentlemen, anything?
All I'd add is patience is a virtue, and that's what I've learned here. It's an industry we work in that moves very fast day to day, and we can appreciate that and lean into that. And then the adoption, again, will take probably longer than we hope sometimes, but the demographic trends are our back, and that's, I think, the story, if nothing else.
Yeah, just a quick point on the shift from the Star Wars analogy. A lot of folks on the policy and regulatory side, rightly pointed out that they felt like we were targeted. If that environment changes, I think also kind of our approach is going to have to change, and we're going to have to be much more constructive in what we want from a regulatory and policy perspective.
Audience, please join me in thanking our panelists.